QQQM's 125% return crushed DFUS's 80%. But that extra 45 points came with heart-stopping volatility you'll need to stomach. QQQM more than doubled your money in 3 years. That's the kind of return that changes financial futures fast. But here's where it gets interesting. DFUS delivered a solid 80% over 3 years, but that 45-point gap tells you everything about these strategies' different approaches. In plain English, total returns tell the whole story. QQQM's blazing ahead like a race car hitting top speed, while DFUS cruises steadier. Both cross the finish line, but QQQM's clearly built for pure acceleration. Now let's put this in perspective. QQQM doubled your money over 5 years. With a 103% return, that's the kind of performance that builds real wealth. Here's where the story takes a turn. DFUS put up solid numbers at 72%, but it's clearly falling behind QQQM's faster pace over 5 years. Let's break this down further. QQQM's delivering solid risk-adjusted returns here. That 1.3 Sharpe ratio means you're getting paid well for the volatility you're taking on. But what about DFUS hits a 1.1 Sharpe ratio? Solid risk-adjusted returns, trailing QQQM slightly, but still holding respectable ground here. In plain English, think of Sharpe ratio as your investment report card. A higher score means you're earning solid returns without riding the volatility roller coaster. Basically, you're getting paid well for the risks you're actually taking. Let's dig into the details. QQQM's Sortino ratio of 1.8 means you're getting solid returns while avoiding the downside volatility that really hurts your portfolio. Here's where things get revealing. DFUS's Sortino ratio of 1.5 measures downside risk only, showing you're rewarded nicely for the volatility that actually stings. In plain English, think of Sortino like a swimming pool depth marker. It only measures the dangerous drops into the deep end, completely ignoring those harmless bumps in the shallow water that don't hurt you. But wait, there's more to this story. QQQM's worst drawdown hit negative 35%. That's watching over a third of your investment disappear during the roughest market stretch. Here's the thing though, DFUS's worst drop hit 25%. Painful for sure, but 10 points better than QQQM's brutal 35% nosedive during downturns. In plain English, maximum drawdown shows how bad things can get during a crash. QQQM's building lost more floors before stabilizing, while DFUS experienced a smaller, less dramatic collapse when markets shook. Now here's where it gets tricky. After hitting rock bottom, QQQM needed over a year to break even. That's 13 months of just holding and hoping. But that's not the whole picture. DFUS took 439 days to bounce back, surprisingly slower than QQQM, even though its drop wasn't as deep. In plain English, recovery time separates tough funds from brutal ones. Like a marathon runner limping back to pace after tripping, how long it takes to recover reveals just how patient you'll need to be. Here's what really matters. QQQM's sitting at 11% volatility. Expect your portfolio to swing noticeably, but nothing that'll keep you up at night. Now let's connect the dots. DFUS is keeping things pretty calm with just 8% volatility lately. Perfect if you prefer smooth sailing over wild rides. In plain English, think of recent volatility like a roller coaster's final loop. QQQM's been jerking you around with wild swings, while DFUS gives you that smoother, less stomach-churning ride to the finish. Let's unpack this a bit. All right, quick pause here. Who's your pick? QQQM or DFUS? Let me know. Here's the key takeaway. QQQM's 22% volatility over 5 years reveals the wild swings you'll endure chasing concentrated tech bets long term. Now, let's flip the script. DFUS keeps things steady at 17% volatility, 5 points calmer than QQQM, meaning smoother rides through market swings over 5 years. In plain English, storm brewing over 5 years tells us everything about risk tolerance. QQQM's heavier thunder means wilder swings, while DFUS keeps things calm and steady. Choose your weather wisely. Let's get into the weeds here. Over half your investment rides on tech alone. That's huge concentration risk if the sector stumbles. Now, let's shift gears and look at DFUS dials back tech to 33%. Still substantial exposure, but 20 points less concentrated than the typical tech-heavy fund. In plain English, here's the tech allocation showdown. QQQM loads up more than half your portfolio with technology, while DFUS keeps it to just a third. Think different pizza dinners. One's tech-heavy, the other leaves room for variety. Let's zoom in on this. QQQM's 17% communication services weighting brings more tech-adjacent exposure, piling on another layer of concentrated risk to your portfolio. But here's where it gets interesting. DFUS takes a more cautious stance here, allocating just 11% to communication services, 6 points lighter than most growth portfolios. In plain English, here's how the amplifier knob works. QQQM cranks up the volume on communication services, think media and telecom, while DFUS keeps things dialed down. More exposure means bigger swings both ways. Let's break this down further. QQQM's got a massive 70% bet on tech and communications. Your portfolio's all in on growth and innovation sectors here. Let's dig into the details. DFUS gives you growth with balance, 44% in tech and communication, but 26 points more diversified than pure tech plays. Now for the real question. With just 103 stocks, QQQM's concentrated. Each holding carries serious weight, meaning every company's performance directly impacts your returns. Let's dig into the details. DFUS spreads your money across 2,393 companies. That's 23 times more diversification, protecting you from any single stock tanking your portfolio. Here's the clear trade-off. QQQM's 125% returns came with brutal 35% crashes and heavy tech concentration. DFUS delivered 80% gains with steadier 25% drawdowns and broader diversification. Pick your risk appetite. In plain English, QQQM's got just 103 holdings, while DFUS spreads across 2,393. That's the egg basket principle in action. When one stock cracks in QQQM's concentrated portfolio, you'll feel it way harder than in DFUS's diversified approach. But wait, there's more to this story. At a PE of 24.9, you're paying nearly $25 for every dollar these companies earn annually. DFUS trades at a PE of 22, meaning you're paying that much for every dollar of earnings the companies generate. In plain English, think of PE ratios like couch change. You're trading for prizes. QQQM makes you hand over more coins per dollar of earnings, while DFUS gives you a slightly better exchange rate on your investment. Now here's where it gets tricky. That 3.3-point valuation gap tells you everything. Investors expect QQQM's companies to deliver faster earnings growth than the competition. In plain English, think of growth premium like rocket blast-off tickets. QQQM passengers pay extra for the faster spacecraft, while DFUS riders accept slower speeds for lower fares. You're choosing between speed and cost. Let's see how this plays out. QQQM's dirt cheap at 0.15% annually, just $15 per 10,000 invested, making it one of the lowest cost options available. Here's what really matters. DFUS keeps costs ultra low at just 0.09% yearly. That's 6 basis points cheaper than QQQM, saving you money on every dollar. In plain English, think of expense ratios as couch change. You're constantly dropping while maintaining your fund. DFUS loses fewer coins between the cushions each year than QQQM. Your money stays where it belongs. But hold on a second. 6 basis points might sound trivial, but compounded over 30 years, you're talking thousands of dollars saved on large portfolios. In plain English, here's how compound fees work. Like dominoes falling in slow motion, each small fee knocks over next year's growth, and decades later, you're staring at a massive pile of lost returns. Here's the key takeaway. QQQM's 27% annual turnover means roughly a quarter of the fund's holdings get swapped out every single year. Now let's flip the script. DFUS holds stocks for years, not months. That 2% turnover means they're buying and holding, not frantically trading away winners. In plain English, annual turnover reveals trading strategy. QQQM is constantly swapping holdings like switching dance partners mid-song, while DFUS commits to its positions, dancing with the same partner almost all night long. Let's get into the weeds here. QQQM's 27% turnover means more taxable gains hitting your account, while DFUS's 2% approach keeps Uncle Sam away longer. In plain English, tax drag's like paying the taxman early versus later. QQQM's frequent turnover means you're cutting more checks to Uncle Sam, while DFUS holds tight and defers those bills down the road. But here's where it gets interesting. With $72 billion in assets, QQQM's massive scale means you'll never struggle to buy or sell when you need to. Let's zoom in on this. DFUS manages $18.5 billion, smaller than QQQM, but you'll still get efficient trading and tight bid-ask spreads here. In plain English, think of assets under management like swimming pool size. QQQM's got the bigger pool with way more swimmers, while DFUS gives you plenty of room without all that crowding. Here's where the story takes a turn. QQQM's 45-point lead came from betting big on just 103 tech stocks, instead of spreading across 2,400 holdings. In plain English, here's the takeaway. QQQM's tech concentration delivered massive wins, while DFUS's diversification kept things steady. Sometimes putting all your eggs in one basket pays off, if it's the right basket. But there's a catch. That 103 stock concentration that powered QQQM's 125% rally also fueled its 35% crash. Concentration cuts both ways when tech stumbles. In plain English, QQQM's tightrope, walking on concentrated bets. You'll reach spectacular heights when tech soars, but one misstep hurts more. DFUS spreads risk wider, keeping you steadier when markets stumble. Let's dig into the details. With decades until retirement, that 404-day recovery from a 35% crash, it's just a blip on your investing timeline. Here's where things get revealing. DFUS's 25% drawdown beats panic selling during crashes. You'll actually sleep better watching smaller losses than enduring 35% drops. In plain English, here's your choice. Chase outsized gains but toss and turn at night, or sleep well knowing you're building wealth steadily. Your mental health is worth protecting too. But wait, there's more to this story. QQQM delivered bigger returns at 125% versus DFUS as 80%. But you're paying for it with higher volatility and concentration risk. In plain English, here's the bottom line. QQQM's like a race car, thrilling speed, but you'll need steady hands through the curves. DFUS is your reliable sedan. Gets you there without the white-knuckle moments. Now, let's connect the dots. So there you have it. QQQM, if you're hunting maximum growth. DFUS, if you prefer steadier, smoother sailing ahead. In plain English, here's the mountain summit analogy for you. QQQM's the steep technical climb with big rewards and risks, while DFUS takes the gradual trail, slower, steadier, way less intense. Here's the key takeaway. The fine print matters. Always do your homework before putting real money on the line. Let's see how this plays out. If you love these ETF breakdowns, hit subscribe. I'll bring you weekly head-to-head comparisons packed with data you can actually use.